In the first quarter of 2020, as a pandemic shut down the world and the S&P 500 fell about 20%, one small fund did something almost nobody else did. It reportedly returned more than 4,000%. Not $4,000. 4,000%. While nearly everything else was collapsing. This is the story of how that happens, and the catch that never makes it onto the poster. The fund is Universa Investments. Its entire job is to lose small amounts of money almost all of the time, on purpose, in exchange for one enormous payoff when markets crash. That approach has a name: tail risk hedging. And the engine underneath it is a single idea from options math. Convexity. Here is the payoff up front. You do not need this fund to use the idea. Convexity is just a payoff that grows faster than the thing causing it. Understand that one shape, and you understand why a tiny position can quietly swamp an entire portfolio in a panic, and why almost everyone abandons it right before it would have worked. Start with who runs it. Universa was founded by Mark Spitznagel, with the author and former trader Nassim Taleb as an advisor. By 2020, the firm was associated with around $11 billion. But the strategy is not $11 billion of bets. It is mostly ordinary exposure, with a thin sliver of capital spent on deep, out-of-the-money put options. Puts are contracts that only gain if the market falls. Deep out of the money means they only pay off if it falls hard and fast, well below where it trades today. Most of the time, those puts expire worthless. The fund bleeds a little, quarter after quarter. Investors hate that bleed. It feels like paying premiums on insurance for a house that never burns down. They watch the steady drip of losses and ask why they are paying for a disaster that never comes. So the real question is simple. What happens to that insurance on the day the house finally catches fire? Here is the machine. A normal investment is roughly linear. The market goes down 10, you lose about 10, down 20, you lose about 20. 1 unit of pain for 1 unit of move. A deep out-of-the-money put behaves nothing like that. When the market is calm and far above the strike, the put barely moves. It looks dead. But once the market falls past that strike, the put's value does not rise in a straight line. It accelerates. Each additional drop is worth more than the one before it. Plot that, and you get a curve that bends sharply upward. That upward bend is convexity, and in a real crash, it gets supercharged for a second reason: fear. When markets fall fast, the price of options themselves jumps because everyone suddenly wants protection. So the very same put is now worth more on 2 fronts at once. The market fell past the strike, and panic made every option more expensive. Multiply those 2 effects together, and a small, cheap position turns into a fountain. That is the entire trick. Not prediction, geometry, a payoff shaped to explode precisely when everything else implodes. Now the catch the headline number always hides. That 4,000% was the return on the tiny insurance sleeve, not on a whole portfolio. A former AQR strategist put it plainly in Bloomberg. The figure is legitimate, but it comes with an asterisk. The fund reported roughly 3,600% in the single month of March 2020, measured on the put allocation alone. What mattered for an actual investor was a much smaller and much more useful number. Universa's own framing is that clients put only about 1 to 3% of their capital into the hedge and leave the rest in ordinary market exposure. By that math, a roughly 3% allocation added on the order of 13 percentage points to a normal S&P portfolio in March 2020, not 4,000. 13. That still turned a brutal month into a roughly flat one, which is extraordinary. But it shows the gap between a sleeve's eye-popping return and what it actually does for the person who owns it. The poster number sells. The portfolio number is the one that matters. So picture that quarter from the inside. As the S&P 500 fell about 20% and volatility went vertical, those dead-looking puts went off like a flare. The reported figures were staggering. Around 3,600% for the month of March. Around 4,100% for the full quarter. On the other side of that trade was everyone who had quietly done the opposite for years. Sellers of cheap crash protection, collecting small premiums, assuming the big one would not arrive on their watch. For a long, calm decade, they were right, and they looked smart. Then the math reversed on all of them at once. The tail they had been paid to ignore became the only thing in the market that mattered. That is the uncomfortable symmetry of convexity. Someone is always on the other side of the explosion. So the lesson is not to go buy crash insurance, it is a lens. Most of the time, hedges like this look like dead money, and that steady bleed is exactly why most people abandon them right before they would have paid off. Convexity is the trade between a constant small cost and a rare giant payoff. Whether that trade is worth taking depends entirely on the price of the insurance and on how long you can stomach losing. There is no free protection. The forward question to sit with is this: after a long, calm stretch in markets, is crash protection cheap because the risk has genuinely gone away, or only because everyone got tired of paying for it? Those two worlds look identical right up until they do not. More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational, and it is not financial advice.